Okay, good afternoon, everybody. My name is Michael McNellis. I'm an options strategist with Key2Options. I began my career with J.W. Gant Investment Bankers, and then I founded a company called Hat Shack. We were a mall-based retail chain store that grew from 49 stores before selling to a publicly traded company called Genesco. I've been trading since then for over 20 years. I've traded equities, options, futures. I've traded options for cover call writing, hedging, capital appreciation, as well as trading S&P options, futures, oil, natural gas, gold, and the U.S. dollars. I'm joined alongside Ashok Yarlagadda. He is the creator of Key2Options. He's a trader and computer software architect, and we're pleased to have you all here today joining us on how to trade during options earnings season.
Hi everyone.
And before we get started, just a quick disclaimer. Key2Options and Key2Stocks is owned and operated by Capmark Solutions, LLC. Does not give business, financial, professional advice. Materials for Key2Options and Key2Stocks are for informational purposes only. Help investors educate themselves. No reliance based upon the contents. Key2Options and Key2Stocks does not warrant the accuracy or suitability of any information contained on the website, nor any other links or references to other websites, persons, or information. Key2Options and Key2Stocks accepts no responsibility for any loss, damage, cost, or expense, whether direct or indirect, incurred by you as a result of any error, omissions, or misrepresentations in information on the website. Key2Options and Key2Stocks do not accept liability for errors, omissions in, delays, interruptions to, or cessations of access to the website through negligence or for any other reason whatsoever. Past performance is not an indicator of future results, and you can lose more money than you invest in options trading. Key2Options is a software program that allows traders to build quantitative models and backtest them to determine their profitability. Backtesting is a method of determining what if I had applied investment strategy X during period of Y. Key2Options gives you the power to analyze data. Key2Options combines quantitative modeling with proprietary state modeling. The three components of quantitative trading models are: one, strategy identification, finding a strategy that matches your risk-reward profile. We have over 30 option strategies to test your trading models. Two, strategy backtesting. We use historical options data to backtest your trading model. And three, risk management. Capital allocations and risk management per trade can be configured based on your parameters. With Key2Options, you also are gaining access to our proprietary state modeling. And state modeling is a mathematical model of computation in which stocks and indices are placed into one of 8 states. It is based on discrete mathematics called finite state machine or finite state automata. A conceptual understanding of finite state machine, let's think about a traffic light. That can be thought of as a finite state model. It has 3 states, red, yellow, and green, and it can only be in one state, which we call the current state, at a time. When certain conditions are met, such as time passes or a pedestrian crosswalk button is pushed, the light changes from one state to another. In Key2Options, each stock or index is indicated as either bullish or bearish, and at any given point in time, a stock can only be in one state. That state is called the current state. Condition is triggered based on our proprietary indicators. The stock will change or transition to another state. We have 8 states which a stock or index at a given point in time. States 1, 3, 5, 7 are bullish, while states 2, 4, 6, and 8 are bearish. State 1 is our extreme bullish, while state 8 is extremely bearish. In real estate, it's location, location, location. But in the option market, it's volatility, volatility, volatility. Historical volatility is the measure of how much the underlying has moved historically. It can be measured over different time frames. But implied volatility is the measure of the underlying future price volatility. The effect that implied volatility has on the premium or the price of the option is known as vega. A 1% move in implied volatility will equate to a price of the option expressed in a form of a decimal, say 5 cents. Say an option was priced at $5. If the underlying stock price did not move at all, but the implied volatility gained 1%, then the price of the option would be increased to $5.05. Typically, we will see volatility rise prior to earnings, making options very expensive. Prior to the news announcement, the volatility will rise, and post the announcement, the volatility will collapse or crush. With Key2Options, we have 6 different categories of earnings plays. One is the mover, and that's a stock that has a one-day price movement of more than 10% of the move the day after earnings, 3 out of 4 of the last earnings. So we're looking for stocks that make dramatic moves the day after earnings. Some good strategies to use for movers are long straddles, long strangles, or short calendar spreads. For the non-mover, a non-mover is just the stock that has a one-day price movement of less than 10% the past 3 out of 4 earnings. The next 2 categories of options plays are runner and pre-runner. The runner is 3 out of 4 earnings period. The stock price will move greater than 5% 20 days after the earning announcement has been released. The pre-runner is 3 out of 4 earnings periods. You will see the stock price move greater than 5% 20 days before the earnings announcement. So the pre-runner, we see a movement of the stock price, either positive or negative, before the earnings announcement, and the runner is post the announcement. And finally, our last 2 are our volatility play, where we search for stocks that 4 out of the last 4 earnings periods have a 30-day implied volatility that has risen more than 20%. We also look for correlated stocks, which is a statistical measure of how 2 securities move in relation to each other. We can judge Coca-Cola and Pepsi. Before we go any further, I'd like to take a poll and ask you, do you guys currently trade earnings announcements now? In your chat box, you'll see a poll. And if you can just take a brief second to answer that. And we'll give you a few more seconds to go ahead and jot down the answer. So it looks like it's just slightly, about 50-50 we do trade during earnings. One of the reasons why people don't trade during earnings is because of the volatility of the market. And that's one thing the Key2Options program will help you deal with. So let's go into the Key2Options program. And today, due to time, we only have so much time to get through, but we're going to start with the mover. And we'll see how we can scan for stocks that are mover stories. So we go to the Key2Options login page, and we'll go into Key2Options. And from here, I'm going to create a signal. And here we have different signals. I'm going to go to our earnings, click on earnings, and I'm going to go to our close button. One day after, greater than 10%, and we're doing 3 out of 4 earnings.
Mike, just to be clear, we are looking for a price movement in either direction. It doesn't matter what direction the stocks goes, because our intention is once we find a mover, which is a great setup for a straddle or a strangle, so we are that's the reason we are looking at either directions.
That's right. So I'm going to go ahead and save that. I'm also going to look for prices of stocks that are at least $20 or greater. So I can add that into my list to look for. So I'll save that. I'll call it Mike's Movers. And I'll create that. Now what I want to do is, using that criteria, I want to scan for the list of available stocks. So what I'll do is I'll go to Signal. I'll use the signal that I just created, Mike's Movers, and I'm going to scan for the entire list of stocks. I'll hit execute. I'll give it a stock list name. And hit execute. And now I've found stocks that meet that criteria of being movers. Due to the options pricing, due to the implied volatility run-up, we have to have stocks that create a movement above 10%. That way we can actually make money on buying a straddle on them. So here we see some different issues. Let's take a look at LinkedIn, for example. Now we'll do some analysis before we go ahead and build a trading model. And built into our program, we have an earnings tab to look at different information pertaining to LinkedIn. So here in the first chart, you can see the frequency. Beneath are the movements that we see in LinkedIn at earnings time. So you can see there's very few times that it stayed stagnant. We have generally a movement from 11 to 22% on the positive side and all the way down to 43% on the negative time. Now this goes back 4 years worth of earnings data. And now I'm going to hand it off to Ashok and let him explain a little bit more about the charts for plays.
Yeah, Mike, let's also do one more thing. And LinkedIn is definitely a mover setup for this particular current upcoming earnings season, and it's coming out on April 27th as of what we know as of yesterday. But let's pretend and go back in time, and let's go back to January 4th, and then say like we are getting prepared to the earnings movement test in the previous earnings season and how we would have strategy, and that would lay the foundation for us to as a homework for the next upcoming season.
Great idea. So anytime in Key2Options, by changing the date up at the top, we can go back in time and see how prices reacted previously. So anytime we want to do that, whatever our header date is the date that all the data will show.
Okay. And in this particular analysis, we would look at our understanding is our attempt in this particular charts is all about study about that particular instrument with respect to the earnings announcements. So in the right side in this particular chart, it is showing that for the past 16 earnings, which encompasses 4 complete years, the trailing years, and it shows quarter on quarter how much the percentage price movement was in the past 16 earnings. And all charts should be read in terms of right to left. So this being the latest, since we are on January, the last one, this one was in October last year, and this one will be in July, and this one is April last year, and this one was January last year, or sorry, February last year. And so here we are seeing the last 4 movements are in either direction greater than 10%. So no wonder like the screener has caught that one. And if you look at in the past also, like LinkedIn has been pretty much like greater than 10%. Most of the times it used to qualify for a mover. And when you come here in this particular chart, we are studying, and we know that as earnings announcement is coming, just about 10 to 15 trading days before, lot of institutional buyers come in, and they start hedging their positions, or a lot of speculators be coming in and buying in either direction, buying puts if they are bearish and buying calls if they are in bullish speculation. So because of this, a lot of movement in volume on the options and the increase in open interest, and the market makers have to hedge, they keep raising the volatility IV parameter, and which is also a good I mean, when IV rises and the option prices also rise, and if you look at the expected move on the options, you pretty much know how much prices, how much stock movement is already baked into the options as well. So on the next day of the earnings, then now the news is out, and it's all the investors have their own opinions on how the actual earnings is versus the estimated one, and on the outlook. Based on these 2 parameters, and the result is known, and the reflection is baked into the underlying price already. So now there is no surprise element. Then the the volatility crashes on the next day.
So Ashok, so prior to the earnings announcement, we see the option pricing and the volatility go up in anticipation because there's an unknown. We don't know what's going to happen, what they're going to announce, whether it be fantastic or terrible. Once that news is out there, then we see this volatility crush where there's no more unknown or uncertainty. And so this is showing us how much the crush is?
Correct. Yeah. In the past 16 earnings, in each one of the earnings, it's showing this. For example, last year October, it was a 27 points crush, meaning if the IV was, let's say, pretend like it's a 100 point IV on any option, any given option which you are buying, and that option came down to 73 points, 27 points down the next day.
Okay.
And likewise, like over here, 100 became 70 points.
Okay.
So to translate these points into the real money is basically you have a Vega on each option, right? So each point, equal to 1 Vega in terms of cents. So the Vega is always in cents, and if it is 20 cents each point, then if over here it will be 27 into 20, which is about how much is that? Struggling on the math. $5.20. Reduction in the option price the very next day. If price doesn't move, volatility comes down, price stays constant, everything else stays constant, the option price will come down by $5.
And then if we're doing a straddle, we and put side too, right?
Correct. Both sides.
Okay.
Yeah, you get impacted by both sides into 2. Pretty much, I mean, it's not exact the same. Vega will not be the same for the call and the put.
Right.
So as
we have
for both sides. That's correct.
Okay.
So all in all, like this particular analysis is to get to an understanding of, on average, how many points should we expect the volatility crash, and how much risk is baked in. And when I say how much risk is baked in, if you are buying a call you're buying a call for $5 and a put for $5, you are buying it for total straddle cost $10. And if $5 is taken buy volatility crash, you need a $15 price movement in either direction, not the $10 price movement.
So by looking at the volatility crush, we can figure out and calculate what kind of movement in the stock we're going to need to make sure that our long straddle is profitable.
That's correct. And a lot of people who start trading new and buying long straddles or long strangles, this is the #1 mistake that which causes them to lose money.
Right,
and
because they don't anticipate the option volatility crushing as soon as the earnings announcement has taken place.
Correct. And a lot of people who are experienced and used to selling, they use these statistics to see how much potential profit exists and how much the risk-reward pattern exists. And for them, probably LinkedIn is not a favorite candidate at all. Like staying out, if your option seller, staying out of LinkedIn is a good strategy.
So with Key2Options, we can discover ideas that are good for people who want to sell premium and also for people who want to go long.
That's correct.
The issue.
Yep, that's correct, Mike.
Okay.
And on the right side, it's a same representation of the same chart, but in percentage basis. On percentage basis, LinkedIn is expected to come down about 30% on the IV alone. And same way, like we have to this IV 30 points rise for a 10-day analysis. This is basically as the volatility, as the earnings come near, the volatility keeps rising. So this is a measure of how much volatility rise happened before the 10 days compared to the earnings day. And it's on an average, it's about 5% increase, 5 to 8% increase on an average in 10 days. And in the 20-day period, it's about 10% increase on a 20-day period. So if you want to buy on volatility and sell before the earnings, that's another strategy. Like,
so we could buy a long call 10 days beforehand,
yep,
and then even sell it before the announcement, just looking for the volatility, in the increase in volatility.
That's correct. And you can buy actually the straddle 20 days before, and because the volatility rises, then there is a very little chance of losing money on that one, as long as you sell that prior to the earnings announcement. On the last hour,
we have to sell it prior to the earnings announcement.
Prior to the earnings announcement. And one good rule of thumb is when you buy options, you have theta, but since your IV is rising, IV has a vega, and you want your vega by theta ratio to be greater than 1. That means your volatility is raising. Volatility is an appreciating asset. In this case,
right,
the vega is an appreciating asset,
and the theta
is a decaying asset. So you need equal compensation or greater compensation. On top of that, like price is not going to stay constant in the 20 days, right? It's going to move up or down.
Right.
So if there is sometimes like stock in anticipation for the earnings announcement, and there is a price movement, and the volume of the buys happen, so you may gain on that one too. Like
so, if we're long, in this case, we're looking for movers, and we want to be long either the call or the straddle. We want volatility to raise, and we want it greater than our theta decay or our time decay, which are two of the main components of options prices.
Correct. And if you want to do a mover play, something like LinkedIn, and it would be very good to analyze out of these 10 days before the announcements, what is a good day to get into a straddle and wait for the straddle, wait for the price announcement, because you want a bigger move. You know it's going to move a lot. And
so we identified LinkedIn as a potential trade from the long side. There was only about 10 or 15 stocks that even met our category for being from the long side. So now with Key2Options, we can go in and build a model and find out what would be the best day to buy a straddle.
Yep, that's correct.
So how do we do that? We go and we're now going to create a model, right?
Yep, we can jump onto the screen.
So we're going to create some entry-exit dates for LinkedIn. We're going to go use our buy-sell criteria, and we're going to type in the stock LinkedIn. And we're going to give it a name of Earnings LinkedIn Movers.
And we're going to select the previous earnings dates. These are all the previous earnings dates. 10/29 last year, July, April, February.
So all the previous quarters of earnings dates, we go, in this we go back 10 quarters, right?
Correct. 2.5 years, 10 quarters. And then we selected it as a mover strategy.
Yep.
And then we just say execute.
Okay, so now we have the dates for all the different time frames. And let's talk about how we get these different dates. So what we do is we go back, let's assume earnings is on a Friday. We'll go back Thursday, Wednesday, Tuesday, Monday, and then the previous week, Friday, Thursday, Wednesday, Tuesday, Monday, correct?
Mm-hmm. That's correct.
And then if it's on a Thursday, we would have one less data entry. It would go back from Wednesday, Tuesday, Monday, Friday, and that whole previous week. So we can have anywhere from 10 to 5 dates per cycle, depending on the date that the earnings fall on, right?
That's correct.
Okay. So now we have our dates of entry, and now what are we going to do?
So we are going to pretend that we are buying a straddle on each one of these days.
Okay.
And wait for the price announcement, and then the very next day after the price announcement, we're going to close the position in this back test.
So in this case, so we need to have some trading rules to trade off of, right?
That's correct.
Okay, so let's create some trading rules, and we'll create trade rules. We'll give it LinkedIn earnings, and we have to tell our program how many dollars we want to spend. So here I have a portfolio already set up for $5,000. If you're new to Key2Options, go to our YouTube page by going to YouTube and typing in Key2Options, and here you'll find out some basic information on how to guide you around the program. Under context, this is an earnings play, so we'll add earnings. We'll leave the time as it is, and we'll select a strategy, and we'll do a long straddle. And we're going to use our monthly options. And to manage our winning positions, we'll just say we want to use 100%
Initial cost
of our initial cost, and when that takes place, we want to close out the option. And for managing losing position, we can say the same thing. And then for our option selection, for minimum days, we're going to go out at least 30 days to 45 days. And we'll use a delta between 45 and 55. And for this purpose, the program, how does it define finding the delta?
A straddle generally meant it's an ATM strike, and an ATM strike delta is usually between somewhere around 48 to 52, and it's not exactly equal to 50. The delta of, if you add the call delta and the put delta, it should sum up to about 100. So if the call delta is about 48 and the put delta will be about 52. So by the straddle definition, first it will find the call delta, which is nearer to that 45.
Okay.
And then it will match the same strike for the put.
Got it. While we're on this subject of what we typically do, today we're looking for a long straddle. Let me ask you guys, look in your chat box, and I've got another poll out there. Can you mark down what you typically trade, what strategy you trade during earnings? We'll give you a few seconds to take a vote. So we've got some people coming in. We see some long calls, short calls. We'll give you guys just a few more seconds to jot down what strategy do you typically use during earnings. And okay, so it looks like a lot of short calls and puts, a few straddles, and a few long calls. Mostly people are selling premium here, so totally understand why you would do that, but we thought we'd give you an idea of how you can make money from the long side as well. So we'll go back to our program here, and now we'll create this.
Give it a different name.
I've already saved that name before, so we'll change it the name. And now our trade rules have been successfully created. The next thing that we want to do is just group this. And so we'll add it to a group. We'll call it Mike's Movers. And give it the context. This is an earnings play. And we'll hit create. Now we've created everything that's necessary to backtest our trading plan. There's two ways to backtest in Key2Options. We can hit the quick button up top, or we can go to our backtest. Now from here, from the drop-down menu, we'll hit our earnings, Mike's Movers trade rules, and our group. And now we'll run a backtest.
So Mike, just to expand on this earnings entry exit dates is nothing but we created about, I didn't remember the count, but about 70 to 80 trades that every day before 2 weeks. Sorry about that. 2 weeks before the earnings, it goes and it's pretending that it's buying on Monday last week and
so it's going to buy on Monday,
day.
Tuesday, Wednesday, Thursday, Friday, all the way up to the earnings date.
All the correct. And then the trade rules, how you are managing the positions, if it's a winner 100% in between, like and 50% loser and whatever your normal rules from the option
whatever the money management rules are.
Yeah, in this case it's a small tenure, small time period we are going to stay in the trade. And then the group is where your execution run reports, the backtest reports are going to stay. So here it's submitted about 9 runs.
Okay.
And the way 9 runs are divided is run 1 is always like if you buy on the last day of the earnings announcement, just before the announcement, and then how it is, selling it the very next day.
Got it. Okay. And so in this case, we know that earnings was on a Thursday, right? And the reason we know this is because we had 9 runs, and so that means we had earnings on Thursday. So run 9 was earnings weeks Wednesday, right?
Correct. Yeah.
Okay.
So here you can see like EW indicates earnings week, W indicates Wednesday always, EW indicates this is again earnings week Tuesday, earnings week Monday, and previous earning week Friday, previous earning week Thursday, previous earnings week Wednesday, previous earnings Tuesday, previous earnings week Monday.
So in this case, we can see that by buying a straddle, the difference between buying it the previous week Monday to the earnings week Wednesday the day before is significant. We made $13,000 by buying before the volatility rose, right?
Correct.
And then you can see in run 9 we only made $1,600 because of that volatility. It's costing so much money, it
Correct.
Doesn't make sense to buy it.
Correct. If you see like in the last 10 earnings, this is about 90% win rate if you buy the previous week Monday for LinkedIn. This will vary for each symbol because it all depends on how much institutional investor is there, how much speculation does it happen, how many traders trade this.
Right, and the reason important is because it tells us now when we can buy, and because we scan for a mover. If you go to any stock, very rarely will you see stocks that are profitable of being long during earnings season. But we've scanned and found stocks that are extremely volatile, that have high percentage moves, and that's why we can find profitable long trade ideas during earnings season.
And if you see the difference, like a lot of amateurs or beginners like buy it on the last day of the earnings thinking that that's going to be the best. But you see like the previous week, Monday is more profitable here, 90% win rate. If you open that run once, you can see the trades very clearly on each one of the trade. And even if this one also, right, like I mean, it's about the biggest loss is about negative 25%, like, which is not much in earnings place kind of options, like, right? Okay. Now let's so another example is like the same example we can. I mean, for if you are a seller, LinkedIn is definitely not.
No, that's not what we want to play with. Correct. Unless we're selling it maybe the day of earnings, and even still, it's such a volatile stock that there's plenty of other stocks we can scan for in a different way. In that case, we would be looking for non-moving stocks, right?
Correct. And you want to show the stocks which are there on the. Let's go today and then see like what's there on the non-mover, since a lot of people are option sellers.
Okay. Okay. So what we're going to do now is we'll go to present date time, and we'll look for non-movers for this upcoming earnings. But if we took this January number and we went out and did the next earnings, we would see that again it was profitable. So certainly something that you want to look for is, if you want to be on the long side, we want to be looking for and scanning for movers. Now we'll take a look for non-movers now for this upcoming season for the people who want to sell options.
Mike, I take it back. Like, let's do that. Let's go to the options chart and then quickly like the next earnings. We'll go back to January once. We'll close this topic and then come back. Like, see, the next earnings was February 4th, right?
Yep.
So let's go to the options chart and can you type in LinkedIn? Okay, and then we'll jump to February 4th on the day of the options, or no, we decided the previous week Monday, right?
Yeah.
So that would be January 25th. Okay, and then we have to go like we're going 30 days out.
Okay.
So we are selecting the March, and 50 delta, 45, close to 50 delta is about
200. The 200 strike price?
No, 195.
Or the 195 strike price?
Yeah, 195 call, which is costing us, 195 cost is costing us $13.6, $13.6 for one contract. And let's quickly take a look at the IV here, and it's 48.38. Okay, and we'll go day by and similarly we'll note the put price, and then we'll go day by day.
So we've got the call price for the long straddle of 13.6, and the 195 put is at 14.93.
14.93, and the IV, if you look at it, 195 put is about 49. Like, so pretty much they are going in line. Actually, it's not much skewed in this case. So right around IV 50, and if you go one day by day, then just take a look at the IV on 126, and 126 IV is about the same, but here you see the Vega is about 29 cents. For every point in change for IV, it's going to increase the option price by 29, or for every IV decrease, it's going to decrease the 29 cents. So let's quickly jump on to the earnings day, February 4th. And then let's go to the IV once. See, 195 is about 60.27. So there is a 12-point jump on that particular option.
And what is the price?
On the price
This is on the put side?
On the put side, it's 17.25. And on the call side, it's 14.2. It's about $31, right?
Yep.
31.50. So that's about, we bought it for $28.50. So that's about $3 difference we bought for,
right.
Less. Okay. And let's go next day.
So profitable trade.
After earnings. So 195 call is 11 cents.
So if we wanted to get out the day of earnings, we could get out with a slight profit.
$3 profit.
About a 10% profit.
Yep, that's correct.
And then the day after, what happens?
Usually what I normally do is I scale down, like once I get a 10% profit, I scale down the 50%, reduce the position, staying overnight, which is, I mean, if you do it, I mean, there will be sometimes there will be a very positive trades, very huge amounts when you are a long buyer.
Right.
But oftentimes if you do the scale down and put only a limited position overnight, that is also a much more, in the long run, over the period of time,
right.
That is much more a consistent strategy to make more money
okay.
in the long run. So here in this case, like LinkedIn dropped down a lot. I think it opened around 125 and it continued the bearish move and closed at 105. So 195 put is $85, Mike.
Wow.
So that's about $55 price gain, like so $5,500 for every contract you own.
Yeah.
In this case.
About a $70 price.
Okay,
and then what about the call?
Call is 11 cents.
Call became worthless,
worthless,
pretty much.
Yeah, pretty much.
So we went from purchasing at $28.53 to being able to sell for $85.11.
Mm-hmm. That's correct. So let's take a look at the non-mover, right?
So that's a way that you can look for stocks. If you want to be from the long side, you scan for movers to find highly volatile earnings plays.
You can do it two ways. You can look at the one-day price change in either direction less than 10%, either 4 out of 4 times or 3 out of 4 times. Like usually, like 3 out of 4 times, you'll get a lot more signals. You want to define the signal, like non-mover. So I do two things. I also put price greater than $20.
So now for these are the stocks that are for people who want to sell premium, right?
Yeah, that's correct.
And so we can scan all of the available stocks that we have. Presently, we have about 1,200 issues, and we're headed towards all optionable stocks here by the first part of the second quarter.
We got a lot of stocks.
Yeah, sure, because that's the reason most people from the long side don't make money, right?
That's correct.
Because the stocks don't move in a great enough fashion for them to take over the volatility pricing.
Correct. Yeah, but also starting folks like who are selling strangles and straddles have to be more careful too, like by not picking a mover. And I mean, sometimes occasionally you lose money by doing a standard deviation, one standard deviation selling on a strangle as well, but you need to know how to manage that. And when you have a loser, but your probability will increase if you avoid some of the movers heavily. And if this kind of methodical analysis will help you putting an edge towards your trading.
So we can do the same thing. We can find out the best day that we should be doing this. So let's go ahead and create that real quick while we have a little bit of time left.
Sure. Is there Apple? Apple is there. Okay, let's do it for Apple likes.
And Apple's got earnings coming up too soon, right?
That's correct.
So again, we're going to put in Apple. We're going to get our earnings dates for it. And then we're going to go ahead and test. And we'll find out which days are the best days to sell Apple options.
So you want to do it as a mover? We can do it two ways. We can do it as a mover or we can do it as a non-mover.
Let's try it as a non-mover this time.
Okay. And the difference is like it's going to create only 10 trades because it assumes that last day selling is always better.
Yep.
And but if you want to see like which day selling is better, you can select a mover. It will create the same trades like from previous week Monday, and you can do the iron condor or a naked selling triangle.
Oh, okay. So you want to do the mover so we can see each day,
sure, Sure, we can do that. Yeah.
So when we do the non-mover, it assumes that the premium is going to be hiked up the most the day before or the day of.
Here it's created 51 trades, and we are going to do the same thing, create trade roll. This time it's a, you want to do the short side?
We're doing non-mover, right?
Yeah, non-mover. Let's sell a short triangle.
Okay.
Okay. Do your 5K.
So we're telling the program through our money management how much we want to spend.
Correct.
We can give our plan money management skills, profit targets, stop losses. We can change based on delta size, change on underlying price. Every iteration that goes into an option, we have the ability and flexibility with the program to change.
Since we are selling, we are selecting the 20-day one.
Right, because we want to get out of it.
Correct, correct. And we want our theta to be accelerated as well.
Theta, our time decay, is working for us now.
And the volatility crush happens the maximum for the nearest options too. And we created that one. And we're going to select that earnings Apple, non-mover. Put it in the Mike's mover group report.
And so you can see how quickly we can get through this. And as a member of Key2Options, we give you one-on-one training sessions as well.
Hit the refresh buttons.
So we'll refresh as the system is going out to pull data.
Oh, it's done.
And again, you can see there's a certain day that is the best time that has a 100% win ratio.
On this day.
On the previous week's Friday would be the best day to create a short strangle. Now, in the case of the strangle, we're going out a little bit wider, and so you're not going to have maybe as many profitable trades as you would in the straddle. Is that right? Because it's not getting as much movement, maybe?
You probably will gain more on the straddle. I don't know that one answer to that, frankly. Like because every earning season it keeps changing, and we have to really. The good answer is to test it.
That's a great thing, because with Key2Options, you don't have to guess anymore. If you don't know what delta is the best to buy or how many days you should go out in expiration, you can test it in Key2Options. There's no longer, you can ask your friend, well, I trade and I trade at the money. Now you can go back in time and test, well, what does it look like if I traded out of the money? And it's as quick as just changing your inputs into the system. And you can see how fast that we can just quickly change inputs once you learn how to use the system and how you can change it. And also with our risk profile. So now that we run this, and I can go to my group, if I want to change something and I want to see, well, what would happen if I changed my winning position, I'm going to hit override, and I'm just going to change, and I'm happy if I get 50%, Ashok.
Okay.
So I'm going to change that.
Also change the option selection to the, instead of 20 days selling, sell the longer one, like you get more premium out of it. As well.
Okay. So we'll change this as well and see what difference, how does that affect our model? Hit back test, and it's as simple as that, of changing different parameters to see exactly how it performs. And again, depending on what day the earnings are, it goes back as many as 10 days before that, right, Ashok?
Yep. The previous week, Monday.
So you can see how quickly it's run it.
So the second run is always from the 11 to 17 in this case. Still, it's a previous week Friday.
Still a winner.
Yeah.
Doesn't change. Again, it's amazing to take a product and you can see this. So everything that you want to know about, every stock that you want to do, if you're trading long calls, long puts from the short side, doesn't make a difference. You can find out how profitable it is. You can change your parameters to find out your money management techniques. Maybe you should be looking to take quicker profits, or maybe you should be, holding on a little bit longer. With all these different iterations within the market, you can now do that.
So let's open up for questions, Q&A. Like, anyone has any questions?
Yeah, if anybody has any questions, we can go ahead in the chat box. Go ahead and type in any questions if you have any. You can go to our website too at www.key2options.com and sign up for a free trial there. There you'll be able to use the system. The only difference in the free trial is that there's only 112 issues as opposed to over 1,200 issues that we have right now. And again, we're headed towards all the symbols that are out there.
Can you unmute? Can you unmute? That way they can ask the question too. I'm not there.
We also have 4 different levels of membership and with different pricing.
Just one more thing. You all know I believe in fathers with dreams. Well, Freddie Rashad, who I've known for over 25 years, is realizing his dreams by turning into quite the baker. you.